Hello everyone and welcome to the show. Today we're going to be looking at, is it worth spending, or potentially spending, your hard-earned money on shares in Cumulus Media? And just the usual quick disclaimer before we start, this is not investment advice, this is just my own personal opinion. So Cumulus Media, who are they? So we'll start with that. First of all, they're listed on American stock exchanges on the NASDAQ. And they are audio focused entertainment companies. We're talking radio and podcasts. We've got some information here that they operate in 86 markets. They've got over 400 stations. The sort of stuff they focus on is sports news, entertainment. You see there's plenty of brands here, and they've got some digital marketing services as well. They've had a rocky history. Several years ago, they did look at bankruptcy, but they've been improving since then. They're quite an interesting turnaround case. They've recently released their results up to the end of September 2021. We're going to have a look at those, and then I will share with you my current position and my plans at the end of the video, so stay tuned for that. So there was a consensus estimate, which we got here on Zacks, which shows earnings per share over the quarter of 13 cents. We're going to keep an eye out to see whether they've beaten on that. And the revenue is expected to be $234 million, which is quite a big increase from the same quarter year before, sort of 19% up. So straight off the bat, we're looking at strong earnings that they believe have exceeded expectations. So with the earnings, we are looking at an overperformance, and we'll go into the details of that. First of all, on the revenue side, so starting at the top, the revenue is $238 million, which is a few million dollars higher than the estimates at 233. As we go down, we now need to look at how they're kind of growing that revenue, and their kind of digital transformation is going very well, moving away from just sort of legacy radio, and they are very much looking at the podcasting business. Now, that kind of digital revenue pot has grown by 67% year over year, which is fantastic and certainly faster than the overall companies growing. So that's kind of driving that growth for them. Their kind of podcast space is doing very well. So according to their information, people listen to their output longer than their peers, and they've had 1 billion downloads over a year, really growing, and they're really kind of monetizing that very well. So we've looked at revenue. Now let's have a look at the cost. Now the cost performance is that they've achieved fixed cost reductions against their 2019 target baseline of $70 million. And just in quarter, they've added 10 million as part of that. So they're doing really well on bringing down those costs, as well as increasing revenue. So that's going to be driving, no doubt, overperformance on the profitability side. And just finally on the costs, so since the restructure in 2018, they've reduced net debt by over $600 million. That's a benefit of $30 per share. Given the share price is 12 and the market cap's $250 million, there's a lot of value that's been generated there in that time for the shareholders. Moving to profitability, all of this sounds very good for that. They have got an EBITDA for the quarter of around about 46 million. That's very impressive, because if you did actually multiply that up, you're looking at 200 million over the course of a year, assuming a flat profile, of course. Market cap's 250 million. So again, there's a suggestion of value here. But all of that kind of led to cash operations of 13 million. Again, if you did the same thing, you're looking at cash operations of 52 million across a year versus market cap 250. So again, suggestion of some value potentially. Now there is quite a bit of capex here, but in line with targets, so it may not actually translate to a good free cash flow, which is what some use as the owner's earnings way of valuing a company. So do bear that in mind. Now we've talked about kind of their profitability, the cash that's generated from that, but let's have a look at the actual balance sheet. So first of all, they have got $153 million of cash at the balance sheet. Again, versus market cap, it's a massive proportion, but there is actually quite a lot of debt as well. Here is the debt profile via the Simply Wall Street website. And you can see that's been dropping over time, and particularly since their restructure in 2018, we went from 2.3 billion down to 1.3. We're now looking at 820 million. It's just been going down, down, down. Management's been doing well at chipping that away. Now, there is still quite a lot of debt, and it is a good part of the balance sheet, and it is bigger than the market cap of the company. They do have a lot of long-term or fixed assets, which they could kind of back off against that. And they have been selling quite a lot of fixed assets over the last couple of years in order to pay down some of that debt. There's your first risk for the company. In fact, your second risk, the first one was free cash flow might be negative based on some of that capex in the quarter. Second one is that there's a lot of debt on the balance sheet, although I think it's manageable debt. Okay, so we've looked at the current position, we've looked at profit, cash, balance sheet. So let's now look ahead to see what's projected to happen. Well, they're suggesting EBITDA of up to 200 million in 2022 and revenue of 1 billion. So that would be fantastic 0.25 forward price to sales ratio just for next year. And that is EBITDA getting close to the market cap of the company as well. Now, EBITDA isn't necessarily the best method looking at the value, but it gives you a nice indication. Right, earnings per share forecast. And we've got here going up to $3 by the, 2 years' time, end of December 23. $3, $12 market price today. That's a really nice forward PE of 4. Although if you look at the enterprise value, taking into account cash and debt, that's more like 16, which is still decent. Yahoo is suggesting 10% a year for the next 5 years, compound annual growth rate, pretty solid. And the analysts are agreeing in terms of next year. We just looked at about 1 billion revenue, and they're suggesting 220 as earnings next year. Now, analysts traditionally, like they've done, look at what analysts have been projecting before, they have beat quite often in terms of their earnings per share. Was that one occasion, quarter 2, where they just missed out? Massive beat for quarter 3. So from my perspective, the summary is this is a company with a good management team. It's turned it around really well. Debt's coming down, revenue's going up, costs are coming down, profitable, and the valuation metrics of forward PE, forward price sale looks very impressive, but there is that debt to take into account. So to me, this looks undervalued, but let's have a look at Simply Wall Street just for another opinion. Now, they are using actually a 10.7% discount rate, which is lower than I've seen them use on most of their valuations. They're suggesting a 4x upside, which is massive. I'm not sure it's quite that much, but that is a very big upside. The other thing is we can look at the more kind of tangible notion of book value per share. That is approaching $20. So therefore, the company at $12.68 is priced under book value 0.65. So you've got quite a good margin of safety there if you believe the book value represents the value of the company well. We've got a couple of things suggesting it's undervalued. Even the enterprise value to EBITDA is below 10 as well, so that's also promising. We've also said, very low price to sales ratio, although it's not really a growth company, so perhaps that's less of an important factor. I do note there's no dividends, as you'd expect with the balance sheet. They're focused on improving that situation. So they can't really be releasing that capital to shareholders. But given the way the company's growing and the amount of value they've created with the debt reduction, they've got other ways of doing that more effectively. All right then, so for me, that looks undervalued, but I want to be transparent and show you how it fits my portfolio. So you'll see that via ShareSite now, which is a great portfolio management tool. Kind of aggregates all the information from the 4 broker accounts that I've got. Particularly, I've got some companies in multiple accounts, and it breaks it down. It's the history, it shows kind of the annualized return, and my holding, which I bought on the 2nd of December, has returned around about 34% on a compound annual basis. So well above any sort of target I have for the portfolio. So it's one of the better performing holdings. Anyone gets this kind of return in a portfolio over time would be happy. It's only one of the stocks in the portfolio, and it's just under 1%. So it's not really a significant part of the portfolio. And I'm looking at this thinking, I want to add to this position. I want to at least double the size. And to do that, because I'm quite low on cash at the moment, I can just sell an oil ETF that I've got, which is just over £400 and has returned around about 90% in the last year and a half. So I'm going to take the profit off the table on that one, reinvest into this one, because I think the upside on this and the undervaluation here is clear. So I want to take advantage of that and make it a large part of my portfolio. Now, I do have a minimum position size for new holdings going forward. My minimum position size for new holdings going forward is £1,000. So any holding will have a significant impact on the portfolio performance. This one's obviously below that, so I'm going to aim to build up to that level over time. I'll buy one tranche now, and if the price drops further, I'll then add a little bit more to get up to that £1,000. That's my plan. That's not me giving you a recommendation to buy, although I think it's very undervalued. Do take your own advice, do your own research. So yeah, if you want to see how this fits into my American portfolio, performance of all those holdings, click on screen now.